Welcome to this conversation. It's that time of the year again. Centum has just released full year earnings for the year ending March 2022. As always, we're delighted to have the man in charge, Dr. James Mworia. Welcome on set.
Thank you very much, Julian. It's a pleasure to be here.
When I look at H1, your operating profit was at 495. Full year is at 592. It looks like the momentum which you had in H1 tapered off in H2. What exactly happened there?
Yeah, thank you very much, Julian. In the second half of the year, you're now dealing with audited numbers. So we had a number of one-off impairments, which were not part of H1. And some of them were related to the reorganization that we did. So the number of subsidiaries that we ceased operations. And therefore, we had to have write-offs and impairments related to those particular entities. So if you exclude the impairments, which are one-off, it was largely in line. Then we had some of our subsidiaries that, and maybe we'll talk about that have dollar-denominated liabilities, and those, as we got towards the end of the year, had an uptick. Now, as you mark those positions to market, but on the consolidated numbers, it was largely related to impairments, which came towards the end of the year.
Okay, I'll be coming back to the FX conversation a little later, but for now, we are in an environment, an operating environment of rapidly escalating costs. And one of the concerns that I have when I look at Centum is because of your real estate business. Unlike the FMCG, where you can easily pass on the increments to the consumer, I'm wondering what wiggle room you have, especially around the real estate business, to pass these escalating costs to the end consumer.
No, thank you, Julian. That's a very good question. That question relates to the Centum Re portfolio, which is a portfolio company of Centum. So one of their business lines is the development of housing. And as you correctly say, costs have gone up. Cost of steel has gone up. Cost of concrete has gone up. Cost of finishes has gone up. Cost of imported finishes from China has gone up. So what it has forced us to do is to thoroughly look at the product from a design perspective, just to make sure that we can improve the efficiency of the actual sold space, because there's a lot of waste and what we found out is that there was considerable room for improvement around efficiency. So on, say, an example, on a build of 10,000 square meters, whereas before we were getting 6,000 square meters of sold space, on the new products we're doing, we're now up to 80% from an efficiency perspective, and that has a significant impact on cost per sold unit. The second area is also how we contract. So previously, we would give a contractor a full contract. So what the team is now doing, they have identified the big elements, particularly steel and concrete, and those they're negotiating directly with suppliers. And so it's coming in as a labor component. The third element is around bulk procurement. So before, what we were doing, each project was procured as an individual project. We are now using our economies of scale to go and negotiate with the manufacturers now for bulk procurement for the various products. And what we found out as a result of this challenge and forcing us to go back to the product and insistence that we don't want to take up price, we've actually improved the product and reduced the cost. So in a sense, it's been a blessing in disguise. But again, if you look globally, commodity prices are now coming back down. They are falling. So because of muted demand, with the increase in global interest rates, there's an anticipation that demand will come down. So prices of steel are coming down. Prices of concrete will come down. So as those come down, I think they'll find a more efficient business. So I always believe there's an opportunity in every obstacle, and in this particular one, it was a chance for us, for that business, to look at just what they do with the product.
I see.
Yeah.
Let's talk about Two Rivers. Clearly still a blot in the numbers. And the question around Two Rivers, you indicate that there are efforts to restructure the balance sheet. And the intimation here is that it's largely in favor of a debt for equity swap. But my question is, in the immediate sense, because of the pressures you're having, especially from an FX side, are there any immediate plans, maybe concessions in terms of waivers on debt payment or composition agreements?
Yeah, no, that's a good point. So in Two Rivers, you have TRDL, and underneath you have TRLC, which owns the mall. So we had challenges in both of those entities. So in TRLC, that was completed in December of last year. So we ended up with a sizable portion of the debt been converted to an interest-bearing quasi-equity instrument. And what that has meant is that now for TRLC, they are at a break even or tending towards profit position after interest. However, now the consolidated numbers that we've presented have taken the position from the beginning of the year. So the TRLC issue is more or less dealt with. Now what we are focusing on is the TRDL equity investment into TRDL. That, the fortunate thing, is because of the location of Two Rivers and the focus now around the development of mid-market housing. So housing that is in the rental target of between 20,000 and 50,000, Two Rivers has a significant competitive advantage. And it's one of the few sites which is available for bulk development. Most of our competitor sites are relatively small. They don't have enough room for growth. And there's a lot of international investor appetite for developments, housing developments, targeting that market segment. So on the bulk of that, we have seen significant investor appetite for equity into Two Rivers. So we have the initiative we are working on right now, the equity raising initiative we are having right now is quite advanced. So we hope we are going to close it soon. And it's not so much to this addressing of the capital structure of Two Rivers is incidental to pursuing the opportunity to develop the mid-market housing opportunity within Two Rivers, which when it's done will also help significantly in the performance of the mall. So although we'll be diluted as existing shareholders, what it means that we'll no longer carry this interest cost. So if we did not have that opportunity, then that would be a challenge. But because of the locational advantages, Two Rivers has the connectivity, the fact that all the infrastructure is done, and the fact that you have about 50 acres and the bulk that you can develop in bulk, I think that has been an advantage for Two Rivers.
Okay.
Yeah.
James, you've been making efforts around this, the equity ventures around Two Rivers for quite a while. And you and I know we're in an environment of multiplicity of shocks. So we had COVID coming in, then we had Russia, Ukraine, and spillovers. How optimistic are you this time that you could actually have a good deal?
You see, I'm relatively optimistic because I know a bit more about where we are and the interest that we have. I think the only sort of shock would be depending on how the elections go and the environment post, because that's what a lot of the international investors are looking at. But in terms of the underlying business opportunity in Two Rivers, I'm very, very confident about that. And in terms of the underlying investor appetite for Two Rivers, remember for a long time, Two Rivers, we focused on the high-end market. So we've now gone to the mid-market, and we validated it with the Mzizi product, which we've come into the market at slightly over 100,000 shillings per square meter, and it's still very profitable. And in that market, for the end buyer, the end user is a tenant. So if you're looking at a two-bedroom unit here for 50,000 shillings, it offers significant price to performance advantages over anything else somebody would get in the market, whether it's in Ruaka or any of those other areas. And then you have the scale. So what I found is that capital tends to follow opportunities like those. And so this, and we've seen it validated in terms of the investor appetite. So I'm reasonably confident for those reasons.
Okay.
Yeah.
Everyone who has hard currency denominated debt in their books right now is struggling with servicing them because of the challenges which we know. Advanced markets are hiking their rates, there's capital flight. We have a bit of a situation here in terms of accessibility of dollars. How is the Centum experience and how are you navigating this?
Yeah, so we have it at several levels. So at Centum level, we have only about $9 million of USD denominated debt, about 10. So we've done two things. One is swap some of our MSP portfolio to dollars, so that then you sort of match the two. So any foreign currency losses experienced on the liability side are then matched by gains on the asset side. But what we also intend to do, once we complete this exit we're doing for CDN, we want to apply some of those proceeds specifically to retire the dollar-denominated portion of the loan. at Centum level. For Centum Re, that portion has come down considerably. So what they have done over the last 2 years and even this year is that the bulk of their debt repayments have again been applied towards paying the dollar-denominated portion of their debt. For a long time when we had currency stability, the interest rate differential between dollar and shillings was so significant that the saving, it was about a 6% annual difference. So there were significant advantages of being in hard currency. So I think the issue now is only largely in TRDL, and that will be cured through what we are doing, because then there will be no debt on the balance sheet of TRDL. So that's what we are doing around it. In terms of significant principal repayments, we've not had any that would then need us to go and look for dollars. It's largely been interest repayments, which have not been as significant, and therefore we've not had a challenge getting the dollars.
I see.
Yeah.
Still on your MSP portfolio, I was surprised that you're cutting back on government debt and opting more for corporate debt.
Yeah, the issue with that portfolio has been, because you have a cost of funding, we have debt of 13%. So if you add renewal costs, etc., it comes to 13.5%. So then the mandate to the fund manager that you need to deliver at least 13.5%. Otherwise, it's better to liquidate and pay down the debt. Now, when you're in government paper, the average coupon is between 11 and 12.5%. So on government paper, what it does is that it reduces the overall yield, and you come below cost of funding. So you then can't have too much of it in government paper. So you have to look for quality corporate issuances where you can then at least increase the yield so that you end up with a reasonable blended yield. What we've now done is then switch also to government Eurobond denominated, because the yields have spiked for various reasons. For our view, we think it's largely perception issues around risk, which might have been overpriced. So at 18% yield to maturity on foreign currency debt, then it makes sense to swap there.
Okay.
Yeah.
Interesting realignment there. On the capital reallocation, one of the underpinning factors here is the pursuit for a potential share buyback. And I've got, I think, 3 questions here. The first is, what are some of the learnings that you would draw from what you've already seen in the market with the NMG experience?
So I think the NMG experience, what it has demonstrated is that a share buyback may achieve a temporary pricing reprieve. So the share price went up and it came back down. So I think it's more or less where it began. So the discussion we've had at the board level is that if we were to do it, then it would not be for pricing purposes. It would be more to give those investors who want to exit, but who can't get liquidity in the market, an opportunity to exit. And for those who want to remain, because you're essentially buying these shares at although you buy them at a premium to market, they're at a significant discount to net asset value per share. If then these shares reduce, then the net asset value per share for the remaining shareholders increases. And because the dividend, we don't issue it on a dividend per share basis, we issue it in aggregate, it therefore means that there will be fewer shares sharing the dividend. So it would then be a win for the remaining shareholders and also a win for those who wish to exit. But as far as it being a path towards sustaining a higher price, that has not held in the case of NMG. Yeah.
So considering what you're saying about share buybacks and the challenges you might have from a price discovery standpoint, the other issue which emerges is the timing. What timing would Centum be looking at to potentially execute this?
We consider share buyback to be a capital allocation decision, which is why the board asked the Finance and Investment Committee to look at it. And you're looking at it as an investment like any other investment, because this is treasury stock. So this would largely be a reallocation of exit proceeds from non-MSP exits into a share buyback. So it would be tied to when we then achieve those transactions. So should we, for example, achieve TRDL, there are some shareholder loans that will be paid back because part of that debt is debt to Centum. Part of that debt that they owe is debt to Centum. So once those funds come, then we would look at it as part of what we would do. The fortunate thing is that for us to sort of buy back about 50 million shares at the current price, we would not need a lot to deploy a lot of capital. Yet, if we achieved what we want to achieve, which is mop up between 0 and 10,000 shares, which are the ones that trade at any price, it may have some advantages to the company as well, without having to deploy a lot of capital. So, from a timing perspective, to answer your question, it is more tied towards when we complete some of the capital activities that we are currently undertaking.
And hence my third question on this matter, because I felt as though Centum might be in a dicey situation, in the sense that the erosion of prices in the market right now has precipitated an environment where you wouldn't have to deploy much capital to actually execute this. But then you are pegging this on another factor, which you've just spoken to. So how would you navigate a fine line here?
And you see what we found out is that although there's been significant erosion of value in public markets, that erosion of value has not been there in the private markets. And most of our transactions are in the private markets. So in the private market, you're still having valuation discussions pegged on the fundamentals of the company. And you've seen it, for example, in the exit of Dividend Bank, where we've achieved what I would consider a reasonable exit valuation. So the factors that have affected us in the private markets have been more the global factors, which is what has slowed down. The COVID-19 pandemic affected a lot. But we are seeing those transactions. We're seeing those transactions coming back. So that's why we wanted to be clear to investors what are sort of our conditions precedent. We don't want to allocate MSP capital to buy back shares, because then that will reduce our allocation into MSP, and then it will reduce also the recurrent income. So whereas it's a good thing to do, we want to do it out of capital from the rest of the portfolio.
Yeah. Okay.
Yeah.
Speaking about Dividend, an exit which, when you look at the numbers, in my view, made a compelling case. Price to book made sense. But speak to it from a factor of the anticipated exit proceeds vis-a-vis the cumulative investment that Centum made in this.
Yeah, the cumulative investment we made was about 4.7 billion. But when we came in initially, we put in 2.4 billion. Over the period that we invest 2.3 billion to continue to support the bank and to support the growth of the bank. So what we learned and what our experience was that growth in profitability is highly capital intensive. If it was not capital intensive, we would not have had to inject the 2.3 billion shillings. And so the point for us was, where do you get your point of optimality? At what point do you continue investing capital, and at what point do you exit and take what it is that you can recover? So for us, had we stayed longer, because of the growth we've experienced over the last 1 year on asset growth, would have needed to inject additional capital. Our capital ratios were around sort of at a point where we needed to provide more capital. In fact, we did provide that capital in December of last year, just for them to meet their ratios.
Yeah.
So had we stayed then, it then adds now to the pressure you're talking about, because now in addition to the buyback, you have another asset here that needs to be funded. And it has now to wait for you to achieve certain exits. And remember, a company is a living organism, if I may use that. So once you slow down the growth momentum of an institution, you can erode a lot of the value that you've created in that institution over time. So it was important for us not to do what was in the best interest of that organization, which was, of course, to try and get an exit. Of course, if we did not get that exit, would have had to put in more capital.
Correct.
To preserve future value. But I think we did what was, in our view, in the best interest of both that institution and our shareholders. So it was quite and you've seen what has happened to Tier 3 banks which have not received shareholder support. Eventually, those investors have exited at zero. So I think the difference for Centum, because this is probably the only substantial exit of a Tier 3 bank in the last 4 years, is our idea around supporting our portfolio companies through difficult times. It is very important in preserving value in the long run. And you know, we've gone through this situation with CDN.
Yeah.
We went through it even with the bottlers. We were the only ones who came through for the bottlers in their rights issue. And that's how we moved from 28% to 54%. It was not doing well. Many investors tend to focus on the here and now and how this, and they make sentimental decisions around whether to invest more capital based on the current performance. For us, we are looking at what this asset could be. We are going through it with Two Rivers. So it's something we've been through that journey before, and I think the only sure way of ultimately creating value and recovering as much of your value is supporting your portfolio companies through those difficult times, and eventually you get a reasonable exit.
Okay.
Yeah.
So one of the things which the CDN exit signaled for me was that, I mean, look, any asset that is non-dividend generating, we are keen to dispense with it, so we focus on more cash generating assets. So on that note, how is your potential pipeline looking like?
You see, CDN was not just the issue of non-dividend generating, it was capital consuming.
Yeah.
So for the return you're getting, you're putting in quite a bit of capital. So that was the issue. And the dynamics of the business are such that you need to have economies of scale. To get those economies of scale, we need to put in a lot more capital to scale it up. So that was the challenge we had with that particular asset, and hence the opportunity. The logic around it is around time to exit. From a pipeline perspective, you know, the assets that we've made the most return on are the ones where there is significant opportunity to increase underlying profitability significantly. If you're going to come in and sort of coast along, then there's really no upside, and there's no justification for the risk that you're taking. But we've had to take a balanced view also, because we've also wanted to shift more assets from P and real estate to MSP. So you also have an asset allocation decision at that point. I think the thing that sort of confuses the market is because, you know, if we are continuously in the market raising funds, then you can also be continuously in the market deploying the funds. But remember, our capital allocation is from organic sources. You have to exit, you have to balance the portfolio, then you have to redeploy. So the recent exits we've done, all those funds have been redeployed towards the MSP portfolio, because you have a huge portfolio, which is a growth portfolio. What we do not have enough of is a cash yielding, portfolio. So where the bulk of the effort is of the team is in achieving the value creation initiatives that need to be done in the individual portfolio companies to be able to take them closer to a capital event. And even moving CDN from a loss position to a profit position was a Herculean task. There's a senior manager who was there for 2 years flat, working with the management team on a daily basis as a portfolio management support to the management team there to achieve that outcome. So that's where we believe we can get the best return on our effort, is on what you're doing with the current, because our capital is locked there. Once you achieve a capital event, you're likely to achieve it at an uplift to carrying value, like we've done in CDN, and then realize capital. Yeah.
And you have actually preempted my next question, but maybe just flesh it out a little more. What do you say to those who are now concerned that there's a disequilibrium between Centum's exits and the deployment of capital?
I think there's an assumption that deployment is only to private equity. But you see, we have 3 asset classes, and you must deploy. So the deployment to MSP, which has increased significantly, those kind of people then tend to ignore, they do not consider that to be a deployment. And yet that is an important deployment, because when you are doing an asset allocation strategy for a company like Centum, you must also look at the liability structure of the company. So if we had allocated all that capital into PE assets, and where a lot of investment holding companies have struggled, is because in this environment, the first thing many portfolio companies cut is dividend. So you need to have a fixed income portfolio, which is something we, from a risk management perspective, way back in 2018, seeing how the economy was performing, our view was that we need to have a shift. So we've been having a strategic asset allocation shift from PE to MSP. There's also another view that we should have invested in listed equities. But again, if you look at the performance of listed equities across, regardless of sector, whether it's in banking, whether it's in technology, even the best, even blue chips, there's been significant value erosion. Again, our focus has been on preserving NAV per share. So that would not have been a safe haven for an investor. So looking at the options one has, I think we've played the best hand under the circumstances. Yeah, under the circumstances, because once you create value, then you must preserve value. And investment funds across the world, regardless of whether they were invested in tech stocks, in cryptocurrency, in bonds, etc., the biggest challenge they're facing now is value preservation, because as interest rates have gone up, they have eroded value. If you have a fixed income portfolio in the US, that has suffered. If you're in cryptocurrency, has suffered. If you're in tech stocks, you've suffered. So it's only that we started grappling with that issue a lot earlier, way back in 2018. Yeah. In case of a downturn, how will we fare? And that's what we've been dealing with. I don't think we've lost much by not deploying into private equity over the last 3 years. We've not lost much in terms of multiples have not increased. If anything, multiples have shrunk. Growth has not been that great. So I don't think you'd say, okay, the fact that we've not allocated capital, for example, the capital we allocated to MSP, the question is that you allocated it to a PE asset, would you have done a lot better? The answer is, if you look at the reality of how the markets have behaved, we've probably saved ourselves a lot of trouble.
Okay.
Yeah.
James, let me wind up this conversation, not keep you too long. The dividend,
yeah.
I'm glad to see it back to where it is right now. But the question is, in view of the capital constraints and the fact that many entities which had now begun to re-engage their dividend in light of the spillovers we're seeing from Russia, Ukraine, and what is happening domestically, are beginning to have a revision of this. How easy or difficult a decision was this?
No, it was a straightforward decision, because the bulk of our dividend is not from the dividend of the portfolio companies, it's from the interest of the MSP portfolio. And we realized this way back in 2018, that we need to allocate a segment of the portfolio to a cash yielding asset class that would generate cash regardless of the performance of the economy, and then tie the dividend policy to that, which is why the dividend policy is on 30% of annuity income. So it's not even on 30% of capital gains. So like the exit we've done, we are not going to pay dividend out of it, because we don't want to distribute capital. And then we went further now also to realign the cost structure of the business, so that again it's no more than 30% of this annuity income. And then went further now to reduce the debt so that the interest can fit. So that sort of gives you breathing room to satisfy all those stakeholders while you're focusing on the value creation initiatives that you need to do on this segment of the portfolio, which when we exit will give you capital gains. So that has sort of allowed us to bifurcate the portfolio. Yeah. So meet your liability requirements from this segment of the portfolio, so shareholders can get a dividend and you are reasonably confident that you can sustain it. And then as you achieve exits on this end, continue allocating more capital there, so that then you can meet their demand for growing dividend. Many of the people who have texted me or who have tagged me on their Twitter handles, the issue they want more dividend. The only solution is shifting from non-cash flow generative assets, which need you to put in more capital, to this MSP, and then put it into fixed income securities so that you can be able to distribute more dividend next year. So this year we're at 30%, which was the dividend policy we communicated in last year. Yeah.
I see. And earlier this year, we saw the deal inked between Centum Re and GM, 17 billion worth of underwriting, as it were, should it go public. Are we within visibility of Centum Re going public?
No, we are not. We are not, because we are from what needed to be done in terms of the underlying performance of the company. As I explained in the investor briefing, the driver of value is free cash flows. And we've been working on increasing the free cash flows of that company. They're now at 1.2 billion. I think next year they'll do about 2.5 to 3 billion, growing. Now the issue is the state of the global capital markets, which was not an issue in October, November, December when we were negotiating this deal, because we inked it, we announced it in January. Now, obviously at that time, the capital markets were very buoyant, but things have changed. Things have since changed, yeah. But that remains on the table. But there's a lot more interest from private markets, because the capital that has been raised for this kind of opportunities by many funds has not yet been deployed. There's a shortage of opportunities. So Centum Re is having that discussion. And our role was to develop this entity from scratch, which is what we've done. Did not exist at all. We did not buy it from anybody. We've created it. It's now a multi-billion free cash flow generating entity. And now Ken and his team are able to have those kind of conversations. And if there's cash into their business as equity, that then means it validates our valuation and probably even increases the valuation, because the valuation is not being based on land values. It's based on the DCF valuation of their business. So that is currently what they're focusing on here.
Okay. And when you made that announcement, James, the concern was that you are abandoning local capital markets, potentially looking externally. Have you since been engaging?
I think for significant capital raises, our markets are not that deep. I don't even think it's an issue of the NSC problem. I think it's just the depth of how deep our capital markets are. If you look at all the exits we've done, and I think we've done the most in this market, they have all been to foreign investors, without exception. Yeah. Even the investments into our projects, they have all been foreign capital flowing into the market. So the depth of capital available for this kind of asset classes is quite limited. Even the conversations we're having now, they're largely with international investors. So it's not that we're abandoning local capital markets. It's just that that's where the capital is available. If you're talking of raising $100, $200 million, $300 million, a lot of it is foreign capital.
Okay. Final question, James, and just to take you back to something we discussed earlier around the share buyback. How far are you in engagements with CMA around this?
So, CMA being a regulator, one is always worried to say how far you are. So, out of respect for a regulator, let me leave it at that. We are going to engage with them. Yeah.
Dr. James Mworia, always a delight.
Yeah.
Thank you so much
Pleasure
for your time.
Thanks a lot, Julian.
Appreciate it.
Thanks a lot.
Centum.